The global commodity markets are entering one of the most unstable and reactive phases we've seen in years. As of March 4th, the joint US-Israel strikes on Iran and the escalating threats around the Strait of Hormuz have triggered a powerful geopolitical shockwave. Today, we're breaking down how this conflict is reshaping gold, silver, crude oil, and natural gas, and what traders should be preparing for next. Let's begin with gold, the anchor of global risk aversion. Gold has entered what can only be described as a parabolic phase, driven by safe haven flows as the Middle East conflict intensifies into a direct confrontation between the US and Iran. Prices are oscillating between 5,300 and 5,450. A clean break above 5,450, which aligns with the 21-day moving average, opens the door toward 5,600. Short-term, gold remains firmly bullish. Mid-term, we may see consolidation once the initial war shock fades, but central banks continue diversifying away from Western assets, keeping a strong floor near 4,800. Long-term gold is being repriced as the ultimate neutral reserve asset in a fragmented global economy, with targets above 6,000 over the next 1 to 3 years. Technically, support sits at 5,280, and the RSI remains above 75, signaling overbought conditions. But in this environment, every dip is being met with aggressive buying. Now let's move to silver, which is riding gold's momentum, but with significantly higher volatility. Silver recently bounced from below $85 and is now targeting 90 to 92 in the short term. It's outperforming gold on a percentage basis during daily spikes, but it remains sensitive to industrial demand, which makes up half of its global usage. Short-term, silver is bullish. Mid-term, volatility will remain elevated, especially if the conflict triggers a global economic slowdown. In that scenario, silver could trade between 75 and 95. Long-term, the green energy transition, solar, electric vehicles, and battery metals keeps silver structurally bullish toward 110. Technically, support sits at 84.50, with resistance at 90. The tightening gold-to-silver ratio continues to favor silver in the current momentum cycle. Next, we turn to crude oil, the epicenter of this crisis. Brent has surged more than 10% in the last 72 hours. The key risk is the Strait of Hormuz, a choke point for 20% of global oil supply. Any attempt by Iran to disrupt or block the strait would trigger an immediate spike toward 115 to 120, and in a worst-case scenario, even 130. Short-term, oil is aggressively bullish. Mid-term, OPEC+, especially Saudi Arabia and the UAE, have spare capacity that could stabilize prices if the conflict remains localized. That suggests a retracement toward 85 to 95 by late 2026. Long-term, demand destruction from high prices and the global shift toward renewables will likely cap oil in the 75 to 80 range. Technically, WTI has broken above 95, with the next major psychological barrier at 110. Support remains firm at 92. Now let's look at natural gas, which is reacting sharply to LNG disruption risks from Qatar and the broader Gulf region. Gas prices surged 22% this week, breaking above the $3 psychological level. If European storage concerns return, we could see a move toward $3.80. Short-term natural gas is bullish. Mid-term, high U.S. production and a mild winter outlook point to a surplus by the third quarter of 2026, with prices likely ranging between $220 and $280. Long-term, U.S. LNG export capacity is set to expand significantly by 2027, linking domestic prices more closely to higher international benchmarks. Technically, gas is trading near $283. Oscillators show a strong sell due to the rapid spike, but the fundamental war risk premium is keeping the trend upward. Let's talk about trade setups. For gold, short-term traders are buying dips near 5,300, with targets toward 5,550. Long-term investors are accumulating any pullback toward 5,000, with targets above 6,000. For silver, the mid-term long setup sits near 85 with a target toward 100. For crude oil, momentum longs are entering near 102 with targets toward 115. For natural gas, speculative longs are entering near 280 with targets toward 350. Finally, here are the three major risk factors traders must monitor. First, de-escalation. Any diplomatic breakthrough between the US and Iran could instantly drop oil by $15 to $20 and gold by $200. Second, Federal Reserve policy. If energy-driven inflation spikes, the Fed may pause rate cuts or even hike, strengthening the dollar and pressuring metals. Third, China's demand outlook, still the biggest wildcard for oil and silver. This is Brianna from FXWMarkets. Stay disciplined, stay informed, and stay ahead of the volatility. FXW Markets.